Okay, so we'll talk about equity incentives and specifically grants to U.S. employees and service providers. So thanks so much for joining us. My name is Shir Sela Pinhas. I'm associate at the high-tech department at Shibolet law firm, and I specialize in all aspects of equity plans and equity compensation. We have Jessica and Justin, Jessica Lutrin and Justin Krawitz from Pillsbury law firm, from their offices in New York. So actually, good morning to you.
Good morning.
Good morning. Jessica is a partner in the executive compensation and benefits practice at Pillsbury, and Justin, as counsel, works alongside Jessica in the executive compensation and benefits practice. And I just want to say we've been working together for some time, and I really enjoy working with the both of you, and both professionally and personally. And I always admire how you're able to find practical solutions to situations that are not always black and white. So thanks, and thanks for doing this webinar with us. This is supposed to be a practical guide for Israeli startups who sometimes struggle with granting equity to U.S. residents. I think we can divide the types of equity to two groups. We have full value awards and we have appreciation awards. So full value awards are, for example, shares and RSUs that are settled to shares. And appreciation awards are, for example, stock options, which in Israel, they're the most popular by far. And in this case, the employee benefits from the appreciation in the underlying share. While full value awards are retention driven, appreciation awards are more performance driven. And so this is something that we see in companies, both private and public. We see a gradual shift to RSUs with some companies. And well, Israeli companies know how Israeli options work. We're all familiar with 102 and the capital gains tax track, and what we can and what we can't do. I think with U.S. residents, from what I encounter, this is sometimes unknown territory or partially unknown. And what works for Israelis does not necessarily work for the U.S. employees. And there's a bunch of rules. There are common practices. And so I think this is what we aim to address here today. And Jessica, the floor is yours.
Great. Well, thank you so much for having us. We really are excited to be presenting to you today. I'm actually going to turn it over to Justin, who's going to kick off this presentation. And we hope you find this helpful.
Thanks, Jessica. So to start the presentation, we thought it'd be helpful to talk about stock options and start with a brief background of what they are, the basics. As you may or may not know, a stock option is a right to buy stock in the future at a fixed price, which would be the exercise price. It provides an incentive solely based on an increase in the stock value after the date of grant. So this would be what Shir was mentioning, the appreciation style award. In the US, the exercise price for a stock option is generally set at the fair market value of the underlying common stock on the date that the option is granted. And stock options are often subject to a vesting schedule and would be exercisable at some point between the date of grant and the expiration of the option, unless the option is granted as an early exercise option that lets you exercise prior to vesting. And there's two types of stock options in the US, one being incentive stock options, which we'll talk about and can provide some favorable tax aspects for the recipients, and the other being non-qualified stock options, which do not provide such favorable tax aspects. So to talk about incentive stock options, which people refer to as ISOs primarily, those are, as I mentioned, options that can provide favorable tax treatment to the holder. These are only available to employees of corporations, so not available to independent contractors, not available if you have a partnership or some other entity that is not a corporation. The rules for incentive stock options require that the option is granted with an exercise price that's no less than the fair market value on the date of grant. And for 10% or greater shareholders, there are special rules which require the exercise price to be 110% of fair market value. And private companies should generally seek to obtain an independent 409A valuation for setting the exercise prices of options. ISOs have a 10-year maximum term for the option, and if you're a 10% or greater holder, it's a 5-year term. So ISOs are not always that attractive to 10% or greater stockholders because they don't want the high exercise price in the short term of the option. ISOs are also subject to annual limits of $100,000. So with an ISO, only $100,000 worth of shares can become first exercisable in a given calendar year. Anything over that 100,000 is treated as a non-qualified stock option, an NSO, and the $100,000 is based on the exercise price of the option. To grant incentive stock options, the plan under which the options are granted needs to be approved by the stockholders within 12 months, either before or after the date that the board approves the grant. And to maintain ISO status, if you're a holder of an ISO, you need to exercise it either during your employment or within 3 months following the termination of your employment. Generally speaking, there are certain rules that give a longer period for death or disability of 12 months.
Okay, so,
sorry.
Oh, sorry, I just have one observation. So this is very similar to what we have in Israel. I mean, the capital gains tax treatment, we also have in Israel, sort of, you can call it a tax track. That's 102, it's called 102 capital gains. But here we see that we have limitations on the purchase price. We have limitations, we have a cap on the value of the award and the exercise term, and the post-termination exercise term. And I have a few questions, because sometimes companies they feel a little bit confused about this, because with Israelis they're allowed to grant a par value, but then with the U.S. residents they have to grant at a higher exercise price, and they fear that this may create a negative sentiment, or how you communicate this to employees or advisory board or board members when you're really trying to provide an attractive compensation package, but you're actually granting them an exercise price which is sometimes very, very high. So from your experience, how do you communicate this to these US persons? Does the company grant all of the employees at fair market value so that there is no there's no difference between the different groups, between Israelis and US grantees, or do you usually see a different price for US residents and for Israeli residents?
I think it varies. We do see certain companies that grant options at one set price for everybody, and other companies that in the jurisdictions in which they can grant options with exercise prices that are lower than fair market value, they'll do that. And then in the US, maybe they'll have some other means of compensating their employees to put them on par with those other employees. It's really a business issue as to how that's rolled out with employees. I think the one thing that we focus on in the US anyway is just to convey to the employees that we are granting you an option with an exercise price that's equal to fair market value. Otherwise, you will be subject to adverse tax consequences. But aside from that, it's really just a business call as to how that's communicated and how you're going to incentivize your employees in the different jurisdictions where they sit.
Yeah, I agree. I think in my experience, maybe it tends to be a little bit more that companies do what is consistent with the jurisdiction in which they're granting the awards, because employees have certain expectations in those countries. So in the US, as Justin was saying, it's very common. I mean, all options are granted with almost all options are granted with an exercise price equal to fair market value. So it's not a surprise to US employees that that's what's happening, whereas I'm sure it would be a surprise to Israeli employees if you were to do that. So I think there is a little bit more consistency among the jurisdictions, but completely a business decision as to how you want to, roll that out and socialize it with your employees.
But with Israeli employees who are also US citizens, you would still have to grant at fair market value, correct?
If they were US taxpayers, yes, I think so. Yeah, that would be our recommendation, even if they're not necessarily located in the US, which I know is a hard pill to swallow.
Thanks, Shir. So just to talk quickly about the last bullet here. So one other requirement of ISOs is that they need to be held for a specific holding period, which is 2 years following the date of grant and 1 year following exercise before they can be sold, and retain their ISO status when they're sold. And we'll talk about the tax aspects of what happens when you sell those shares a little bit later in the presentation. So non-qualified stock options, these are options that do not qualify as ISOs. They don't satisfy the ISO requirement, and therefore they can be granted to employees, they can be granted to directors or consultants, any independent contractors. For different reasons under the tax code, NSOs also have to have an exercise price equal to fair market value, and that's because of Section 409A of the tax code, which deals with non-qualified deferred compensation. The benefit of NSOs is that there's no annual limits. You can have the grant be as large as it needs to be to incentivize whoever is being incentivized. There's no length on the post-termination exercise period, so you don't have to exercise it within 3 months. You could, if you wanted to, set it up to be exercisable for the entire 10-year term of the option, although most companies, even for NSOs, keep kind of the same rules as ISOs. And the primary difference between ISOs and NSOs is tax driven, really. So with an ISO, there's no income or employment taxes when the option is exercised, whereas with an NSO, I'll say generally no income tax or employment taxes. Whereas an NSO is subject to income and employment taxes on the date that it's exercised, and that tax applies to the difference between the fair market value of the stock and the option exercise price on the date of exercise. With ISOs, if you sell them prior to the expiration of that holding period I was just talking about, the 2 years following the date of grant and 1 year following exercise, in that situation, you have what's called a disqualifying disposition. And in that case, the spread value of the option from the exercise price up to the fair market value of the option on the date that it's exercised would be subject to ordinary income and employment taxes. And then anything after that is subject to capital gains taxes. So long as you hold an ISO for the requisite holding period, you can sell the shares and only pay capital gains tax. You don't get subject to ordinary income tax. Whereas ISO or NSOs, you're going to have some ordinary income tax, at least on the spread value when you exercise it.
Okay,
So talking, oh, sorry.
Oh, sorry, I have a few questions here from a few participants on this subject of ISOs and non-qualified stock options. So first, can I grant an ISO to an employee who's engaged through a PEO, professional employer organization? Yeah,
that's a great question. And the answer is yes, you can. For purposes of the ISO rules, the PEO which is only the employer of the employee for purposes of benefits, participation, and payroll, that's kind of disregarded. And so you can have a PEO employee receive an ISO from the actual employing company that's directing and controlling the employee.
Okay, and regarding the shareholder approval, is it okay to first approve the grant with the board and then seek the shareholder approval at a later stage, and that will be a condition to the grant?
Yeah, I mean, yes, you can do that. In our experience, what is most common and what most of our private companies in the US do is that they seek board and shareholder approval on the same day or very close together. But if, for whatever reason, you're not able to seek shareholder approval kind of at the same time that you're obtaining board approval, you can obtain shareholder approval later. The issue with that is there are a couple of issues with that. One, you have to be pretty sure that you're going to get shareholder approval. What we want to avoid is the situation where you make a grant to someone, it's contingent on shareholder approval, and then you don't obtain shareholder approval. It's very difficult in that situation to deal with the grant. You'd have to unwind the grant. You have to go to the participant and say, we didn't get shareholder approval. We're so sorry. We're going to give you cash, or whatever the situation may be. And that's very uncomfortable. Companies don't want to do that. And then the other issue that you need to be mindful of is what would be the grant date for tax and accounting purposes. So when you're conditioning an award on a contingency such as shareholder approval, there is the possibility that the grant date is not going to be the date of board approval, but the date that that condition is actually satisfied. And so that can become a little bit tricky, especially when we're talking about making sure that your grant date is, or that the exercise price is equal to fair market value on the grant date. When that grant date is uncertain, and it could be a date in the future, you may have a higher exercise price. So for all of these reasons, we would recommend that you try and seek board and shareholder approval very close together to kind of avoid some of these complexities.
Okay, wait, I have another question coming in. Okay, so are directors or executives engaged as consultants entitled to ISOs?
No. If you're a consultant, you're not eligible for an ISO.
Just employees.
Correct.
As long as the plan contains the number of shares reserved for ISO and the shareholders approve the plan, is it sufficient, or do you need a separate and express approval of number of shares designated for ISOs? Oh, do you need to have the language of the reservation of the maximum shares that can be issued as ISOs? Do you need to have that in the resolution, or is it enough that it's in the plan and you approve the plan?
Don't take that one.
I think it's enough. If it's in the plan and the shareholders approve the plan and that number's in the plan, then that's fine. But if you subsequently want to increase the number of shares into the plan, just remember that you do have to go back and get additional shareholder approval if you want those additional shares to be eligible to be granted as ISO shares.
Okay, let me see. We have quite a few questions. Okay. Is it actually attractive for employees to get ISOs and worth all of this headache when they're likely to be disqualified because they won't meet the holding period of the 1 year post exercise? Because in many private companies, maybe this is specifically a pain in private companies, the opportunity to sell the share and the motivation to exercise the option is typically either when you leave or if there is a transaction that sort of forces you to exercise. And then you don't necessarily have that 1 year holding period after the exercise of the option. So many of those options which were initially intended to be qualified as ISOs get disqualified because of this holding period post-exercise.
Yeah, I mean, I think for one, in the modern era, it's become easier to keep up with the administrative requirements of ISOs, given that online equity management platforms like Carta and others keep track of the annual limits. They do the annual filing for any ISOs that have been exercised. So to the extent that an employer is utilizing one of those online equity platforms, it's become easier to keep up with those administrative requirements. Secondly, I think most employees are not thinking about it that deeply. They just are thinking, I know there's such a thing as an ISO. They provide tax benefits. I want an ISO. I don't know that they really get in their own thinking up to the point of, hey, I'm going to have a disqualifying disposition most likely, or never even realize these benefits. So why do I care if I have an ISO? I think it's more just like in the marketplace, people are familiar with ISOs and expect to receive them if they're employees. That said, we do see a lot of companies, or I shouldn't say a lot, but we do see companies that have moved to an only NSO option granting practice.
But also, if you grant ISOs, then the tax event will be at the sale and not at the exercise. So that's probably another advantage.
Right. And I mean, the other advantage, it's a small advantage, but depending on how the exit is structured, you can save sometimes on employment taxes if you are granted an ISO. It's not necessarily a significant tax saving, but they could be some tax benefits at the exit. So it's not like it's completely wiped out. And so for that reason, I think, as Justin was saying, there are a lot of executives particularly who want to have kind of the optionality of maybe being able to take advantage of some of these tax benefits. And so because it's not so, because of CARTA, it's not so painful to grant ISOs, it's often just very attractive to people to say, we grant ISOs. People love that. It's a buzzword. They think they could be benefits. And so a lot of companies still grant ISOs.
Okay, we have a few questions here, but I think let's move forward and then we'll get back to the questions.
Okay.
So moving on, we were talking earlier about Section 409A, which are the rules for non-qualified deferred compensation, and we're just going to talk briefly about how those work with respect to stock option exercise prices. So NSOs generally need to be granted with an exercise price that's not less than fair market value on the grant date in order for them to be exempt from those rules under 409A. ISOs have a similar requirement under the ISO regulations that say they have to have an exercise price equal to fair market value. For public companies, the valuation methods that can be used are basically based on reported trading prices. You can look at the trading price, the closing price on the day before the grant is made or the day of the grant. You can look at the average trading prices on the day before the grant or the day after the grant. So there's different things you can do when the stock is publicly traded and those prices are widely and readily available. For private companies, on the other hand, under Section 409A, they need to use a reasonable valuation method to set the exercise price. And the most typical and best way to do that is to obtain an independent 409A valuation report from an entity like CARTA or a third-party valuation firm. And the benefit of that is those have really come down in price recently. Now that CARTA is doing it, and others. So it's not terrible to obtain a third-party valuation report. And the benefit of that is that it's presumed by the IRS to be accurate, and you can generally rely on it for 12 months unless there's some intervening act like a financing or sale or something like that that would call the valuation into question. So and there is also a way to do internal valuations for what are called illiquid startup corporations, which are companies that have been in business for less than 10 years. To do that, you need to look at certain factors under 409A, like future cash flows and minority discounts and what the stock price of peer companies look like. And the list is a little bit longer than that, but those are there are certain factors under 409A that need to be considered in one of these internal valuations. An internal valuation needs to be subject to a written report and needs to be prepared by someone who has experience in business valuations or related kind of business activities, and they need to be in business or have 5 years of experience. And so if you, for whatever reason, you've done a financing round and you don't have a good valuation anymore, if you can, you should not be granting additional options when you don't have a good valuation, and to the extent possible, try to discourage exercises too, if you can, just because you're going to need a valuation to report income on the exercise for NSOs, and also to keep track of it, of the spread value for ISO reporting purposes. So the consequences of violating Section 409A, you've granted an option that has an exercise price that is not equal to fair market value. It's less than fair market value on the date of grant. The consequence of doing that is that on the date of vesting, there will be a 20% additional 409A tax on the spread value of the option, and that's whether or not you exercise it. So it's a pretty bad penalty to get subject to a 20% tax where you haven't even exercised the option, and even if you did, there's no liquidity for the option. And then states in the US can also apply their own rules. For example, in California, they have an additional 5% tax for a discounted option.
And one thing, can I just interrupt? One thing I just want to emphasize, because I think that this is often confusing, is that the 20% excise tax is not calculated on the difference between what the fair market value should have been and the exercise price. It's, as Justin said, it's the spread. So it's the difference between what you actually granted the option at, that exercise price, and then the fair market value at the time of vesting. So if you have a company that's doing brilliantly and your fair market value continues to increase, the 20% excise tax and the income tax can be catastrophic because it can be so much money. And so I think it's an important thing to remember. This is why 409A is so important, is that it can become really expensive very quickly. And I think people sometimes forget that nuance.
Yeah. And we do see some executives who negotiate for specifically a discounted option, which is an option with an exercise price less than fair market value. You can do that under 409A. All it really means is that you are now subject to 409A and you need to comply with 409A. So you can have a discounted option, but you got to structure it to be exercisable only on certain 409A permitted payment events, which would be separation from service, death or disability, a change in control, or a specific date in the future. And generally those need to be set up to require an exercise within the same tax year as the as vesting, or I'm sorry, not as vesting, as the payment event occurs.
Okay.
So
Sorry. So I have a few questions on those sides. So the company has to go through, does the company have to go through a 409 valuation every year? That's one of those questions that.
yes, yeah. So the IRS presumption that a 409A valuation is good only lasts for 12 months, unless there's some intervening act, like we talked about, a financing event or something that would make you have to do it sooner than that. But yes, generally speaking, every year you need a valuation. And
if the company closed an investment round, it shouldn't use the PPS of that round. Is that what you're saying?
You want to take that one?
Yeah, so by PBS, I assume you mean the preferred stock price, right?
Yes, because that's frequently asked but clients frequently ask that if it's possible to use the PPS of a previous round or a round that's just been closed, or a discount on that price instead of doing a valuation.
Right. I mean, you can, because your preferred stock price, because of the preference, is going to be higher than your common stock price. So no reason why you couldn't do that and then avoid the 409A valuation. The downside of doing that is then you are granting an option with an exercise price that is significantly higher than the fair market value of the common stock for employees on that grant date. And that's not particularly incentivizing to employees, because then it takes so much more for them to be able to kind of get the appreciation in the option. So from a legal perspective, you can do it, but from an employee morale perspective, there is a downside. I mean, in terms of whether you want to use the preferred stock price and then take a discount, I mean, that's really a valuation question, not really a legal question. Typically, and this is, again, no bright line test, but in our experience, when you do have a preferred stock price and then you get a 409A valuation, it's usually at a kind of an 80 to 90% discount off that preferred stock price, but that's not built into the law. That's just how things kind of play out. So if the company was going to use a discount off the preferred stock price, we would recommend that you do speak to someone with valuation expertise, or, you know, if you have someone within the company who has this business or finance acumen, they should absolutely be weighing in, because it's not really a legal question. It's more of a valuation or a finance question.
There's an exception where the board can, in good faith determination, resolve on the value of those options.
Yeah.
To the extent that this is what the board decides to do, how should they justify, or what considerations should they take in order to justify the results of this evaluation?
Yeah, so the board can, if the board would prefer not to, for whatever reason, get the 409A valuation, they can set the fair market value. And then the 409A does take that into account. It recognizes that that may be a possibility. And basically, the valuation needs to be reasonable. And one of the core principles of a reasonable valuation is that if it does not take into account all the facts and circumstances at that time, it's not reasonable. So If the company has just had a financing, for example, that would need to be taken into account. And as Justin mentioned, there are a variety of factors that are listed in 409A that would, if you take them into account, would support having a reasonable valuation. So cash flows, comparable stock prices of peer companies, minority discounts, that kind of stuff should be taken into account. And if the board is doing a valuation, we would recommend that it's documented. So having some sort of kind of record of the methodology and how you came to that valuation is really helpful. And where that turns out to be particularly helpful is, 6 months, a year, 2 years from now, when you're having another financing or you're having an exit and counsel for the investor, the buyer is coming in and trying to reconcile your fair market value determination to your option exercise prices. It's really helpful to be able to say, the board did it, but don't worry, we have the methodology. This is why it's reasonable. There is no 409A valuation. So having a record is very critical.
Yeah, and I'll just add real quick, in the US, it's extremely rare to see the US Internal Revenue Service doing audits where they're sniffing out discounted options and bad valuations. Where it really comes up, practically speaking, is when you're doing investment rounds or selling the company, the investors or buyer will, in diligence, be looking at whether or not you have option exercise prices that equal fair market value. So that's where it's going to come up. And then, it can slow down the deal. There could be special indemnities. So practically speaking, it's more of a business issue. I mean, it is, running afoul of the Internal Revenue Service rules, but rarely do we see the IRS becoming involved. It's more like investors and buyers are going to have heartburn over it.
Okay.
So the next slide is talking about repricings, option exchange programs, and cash buyout programs. This is for when we've granted options with a high exercise price, and for whatever reason, the company's not doing great and the stock price has gone down and we want to reprice the options. So an underwater option is an option with an exercise price that is now more than the current fair market value of the stock. There's a couple different things that we can do, or that companies can do, to help their employees out. One is just a unilateral option repricing, where all of the options are amended unilaterally to reduce the exercise price to whatever the current fair market value is. And then the second is an option exchange program, where option holders will be given the opportunity to exchange their underwater options for new options that have a lower exercise price. And that can be done on a 1-for-1 basis. It can be done on a value-for-value basis, and other means of exchanging them. And so 1-for-1 would be just one stock option for one new stock option. Sometimes the exchange is you're going to get a lesser number of shares for your old option compared to your new option, because you're going to have a lower exercise price. And then similarly, they can look at value for value. You can take something like a Black-Scholes valuation. What is the old option actually worth? We're going to give you a new option that has that same value. And the new options that you get with the lower exercise price, those can be on the same or different terms as the canceled options. Sometimes employers will say, hey, look, we're going to reprice the options, but if you want to do that, you got to sign up to a new vesting schedule, something like that. And then the other way that we see this happen is just a cash buyout program, where companies say, we're just going to buy you out. We're going to buy your option for cash. We'll either pay it now in a lump sum or on a deferred basis, maybe subject to vesting. And that's one other way that you can do it. And then just thinking about, is this going to be a one-off event or a recurring event? And to be honest, if you do it as a recurring event, it can create some issues, and it certainly doesn't look great to investors and just the market. So that's another, you don't want to do this too often. So it's one thing to think about. So there are tax rules and tender offer rules that apply when you do option repricing. So if you reprice an NSO to have a lower exercise price, that's going to be treated as a modification of the NSO, which means you again have to test the exercise price to see if the new option has an exercise price that's equal to fair market value on that date. And then if you're doing this all the time, you can run into some issues where do you really have a fixed exercise price if you're constantly repricing the option? So there can be, this floating versus fixed exercise price issue, which might not really work under 409A. For ISOs, it's going to be the new option that employees get is going to be treated as a brand new option. It's separately evaluated. And the one nuance to think about there is the $100,000 annual limit that we talked about for the number of shares that can become first exercisable in a calendar year. In that year that you reprice the options, the old option is going to eat up some of that limit to the extent you had shares vesting, and the new option is going to eat up some of that limit. So, in subsequent years, the old option is not going to affect the limit because it's going to be gone, but it does count in the year that you reprice the options. So there could be some unintended shares being treated as NSOs if you're not aware of that. And again, with an ISO, we talked about the 2-year/1 year holding period that starts over again when you get a new repriced option. And just the last bullet here is the tender offer rules for private companies. If you have more than 10 employees, doing an option repricing can trigger rules where you have to give the employees information about the repricing, about the tax consequences of the repricing, and you need to keep the repricing open for a specific period of time, which is 20 days.
I have a question. If a company granted a discounted option and they want to fix the award, is there a time frame that they can do this? If they cancel and regrant, what are the implications? Or if they modify the award, what are the implications?
So there are corrections. So one, just want to make it clear, you cannot just cancel it and re-grant. If you have a bad option under 409A, you can't cancel it and re-grant because there are substitution rules under 409A that apply to prevent that from happening. There are IRS correction procedures for discounted options. There is some availability to obtain relief and reprice an option, but it's limited. It generally applies in the year of the grant or in the year after that. And there are other requirements that go along with that, as well as some filing requirements with the IRS. So you can do it on a limited basis, but it's not that easy, and there are requirements that need to be fulfilled.
And I guess the third option, Justin, would also be, which what we talked about would be to keep it as a discount stock option, but then to amend it so that it is only exercisable on certain permissible exercise events, like the change of control, separation from service, or fixed date. I think that in my experience, at least, that approach is generally only utilized when the IRS correction procedures are not available and you're kind of stuck. Because when you have a discount stock option that has been amended so that it's only exercisable on certain events, that's not really attractive again to employees because it doesn't operate like a traditional option. And so there are these limitations on when you can exercise it, and people try to avoid it to the extent possible.
Yeah.
Okay, great. So that covers stock options in quite a bit of detail. And now we're going to move to a different type of equity award that we tend to see private companies in the US grant. And that's a liquidity contingent RSU, or restricted stock unit. A restricted stock unit is really a right, it's a contractual right to receive stock, and it's contingent upon the satisfaction of 2 events. So the first one is that there's typically a service-based vesting condition. So in other words, the individual has to continue to provide services to the company. And then the second one is that there must be the occurrence of a liquidity event, so an IPO or a sale. And if there is no liquidity event during the term of the RSU, the award is forfeited. One of the benefits of granting a liquidity contingent RSU is that you avoid all of these hurdles and that we were talking about with respect to exercise prices, because RSUs are what Shir was talking about at the beginning of the call or the presentation. It's a full value award. So there is no exercise price associated with an RSU. So having to avoid going through 409A valuations and things like that can actually be pretty helpful. And an RSU is taxed as ordinary income upon the delivery of the stock. Or at the liquidity event. I mean, technically the way that an RSU is actually taxed is that when an RSU vests, it's at that point in time that you have to pay the employment taxes, and then ordinary income taxes actually due at the time that the stock is delivered to you. So as we were saying, one of the advantages of granting an RSU over an option is that there is no need to determine fair market value at the time of grant because there is no exercise price. So you don't have to get 409A valuations. There's also no tax that is payable unless and until there is a liquidity event. And that's very helpful because presumably at the time that you're experiencing a liquidity event, the employees will actually have liquidity. They'll have the cash available to be able to pay the taxes that become due at that time. And there can be less shareholder dilution associated with an RSU. So whereas you may have to grant an option for 10 shares because there's an exercise price associated with the option, you may be able to grant a lower number of RSUs, so like 4 shares, for example, because you don't have to take into account the exercise price. And then when you're thinking about how many RSUs to grant an employee versus if there was an option, you could look at, say, the Black-Scholes valuation and say, okay, the Black-Scholes valuation of an option is X. We're going to grant an RSU with a similar Black-Scholes valuation. So while there are some advantages to granting an RSU over an option, there can also be potential disadvantages. So as we were saying, the risk is that if there is no IPO or if there is no sale within the term of the award, then your right to acquire the shares goes away. And that's important because, and we'll get to this in a little bit, you have to be pretty comfortable or confident that you are going to have an exit event within the term of the award. If you think that there's a good chance that you're not going to do it, then potentially a liquidity contingent RSU may not be the appropriate instrument for the company. As we mentioned, an RSU is taxable at ordinary income tax, and there is no potential to get capital gains. So as Justin was describing, if you're granted an incentive stock option, you could have the potential for capital gains. Or if you're granted an NSO, you can exercise the option, acquire shares, and then if you hold the shares for the requisite period of time, you could get capital gains tax treatment in that situation. But unfortunately, that is not available in the case of a restricted stock unit. Also, the tax event is outside of the employee's control. So if you have an option, once it's vested, it's really up to the employee as to when they want to exercise the option and when they want to pay tax. That is not the case for a restricted stock unit. Once it vests and settles, that's when the tax event happens, and you can't really control that income recognition event. Excuse me. There's also less leverage for the employee if the share price will rise significantly. So while the advantage of granting an RSU is that there's less shareholder dilution, a disadvantage is that if you have an option to buy 10 shares, that, for example, could be more valuable to the employee than if you have an RSU with respect to 4 shares. And then the calculation of the compensation expense for accounting purposes is not based on Black-Scholes or a similar methodology that you would use for options. It's based on the value of the shares. So you could have a higher accounting charge if you're granting RSUs. I would say in our experience, accounting considerations tend to be less important for private companies. It's really when you're getting into the public company realm that your accounting expenses can be are more important. We'll talk a little bit about the design considerations of an RSU in a minute, but what I think is important to note is at what point in time does a company decide that they want to grant RSUs? And it's really, I think, kind of 2 factors that need to be taken into account. As I mentioned, do you think you're going to have an exit in the next couple of years? And then the second factor is looking at your exercise price. So when the company's exercise price or the fair market value of the stock is becoming so high that it really doesn't make sense to grant an option because employees are just not going to exercise, it's at that point that you're probably going to pivot to RSUs. So when your stock price is $10, $20, maybe even $200, it probably doesn't make sense to do a stock option at that point. Sometimes what we see companies do is they may do a stock split, but if you don't want to do a stock split, you could pivot to a liquidity contingent restricted stock unit. So restricted stock units, like options, are or could be subject to Section 409A of the code. The way that we get them out of Section 409A is we rely on what is known as a short-term deferral exemption. And so in order for that to happen, you need to have a substantial risk of forfeiture. This is, pretty technical. And then you want to have the option, you want to have the shares delivered to you within a short period of time once that substantial risk of forfeiture has been satisfied. And the substantial risk of forfeitures that we're talking about are the service-based vesting condition and then the liquidity event. And where this comes into play is that you cannot have an open-ended time period for that liquidity event to occur. It needs to occur within a deadline. And most practitioners say, as long as you say that the IPO or the exit needs to occur within 7 years following the grant date, you have an award that would be exempt from 409A. That's a good substantial risk of forfeiture. But if you say that the IPO or the exit can occur at any time, that's not going to satisfy the tax rules because there's no really risk of forfeiture. It's pretty likely that most companies will have an exit at some point in their life cycle, but it's not the case that all companies are going to have an exit or an IPO within 7 years. So provided that the vesting is, if you decide that you want to use an IPO as a liquidity contingent event, that works. And the way that we could do it is you can structure it to say that the shares will be delivered to you on the IPO or until the expiration or once the lockup period, which is typically 6 months, has expired. But the issue with that is, as we were saying, that the shares do need to be delivered within some short-term period once the substantial risk of forfeiture, once the liquidity event has occurred.
Between vesting, you mean there needs to be a short period between the vesting of the RSU and the issuance of the shares?
Yeah, exactly. That's exactly correct. And that short period of time, the cutoff date is March 15th of the year following the year in which the RSU vests. So if I'm granted an RSU and it vests today, the company has until March 15th of 2023 to grant or to settle those shares to me, to give me those shares. So if the lockup is going to expire beyond March 15th, in my example, then you would have to deliver those shares to me earlier. You'd have to deliver them at March 15th. If the lockup expires before, that's fine, but it cannot extend beyond the March 15th date.
So generally you're saying that there's the alternative of granting RSUs, and you're seeing this increasing in companies where the value of the share is high and the exercise price is a burden, and maybe makes the entire incentive not to be very attractive.
Yes.
And then the RSUs are taxed at vesting for US residents, by the way, not for Israelis. They're taxed at vesting, and in order to deal with that, we delay the vesting to a liquidity event. But we can't, between the liquidity event and the actual issuance of the shares, we can't delay that so much.
Correct. Yep. And I mean, my understanding from discussing with you, Shir, is that RSUs are not that common for Israeli companies, right? This is more.
They're not that common with private companies, and this is due to different reasons, because in Israel the tax is different.
Okay.
Because RSUs in Israel would actually be able to be taxed as capital gains in Israel, but also with stock options you don't have to grant a fair market value, so you can grant a par value if you want it. Yeah. With a private company, and because the options still. There are different motivations, because with the options the grantee needs to exercise, so and the value of the option is, like you said, is lower than the full value award. So I think this probably is one of those are a few of the reasons that options are still attractive, still more popular than RSUs, but we are seeing a shift to RSUs with some of the mature companies, and definitely with public companies. Because like you say, the exercise price and the thing with options is that they're really based, I mean, the entire benefit is based on the price and the value of the share. And so it's fluctuable. So with RSUs, when you get it, you get the full award. You get the full value of the award, a grant. So
Right.
these are a few considerations that the companies are considering.
Yeah, that makes good sense. And then the last point, just to note about the design considerations, is that, well, what we were saying is that, you know, hopefully when you have your exit, there is liquidity for the employees so that they can pay their taxes. But there are, of course, certain circumstances in which the exit, the consideration in the exit is illiquid securities. So you may have a private company buyer that comes in and says, we'll buy the company, but we're going to give you shares in our company. And so that doesn't necessarily work from a tax perspective when we're dealing with liquidity contingent RSUs. So sometimes what we see companies do, and this is not always the case, is that they may define the exit event to be the sale of company trigger basically to be a sale in which at least 50% of the consideration is cash or publicly traded securities, to avoid the situation where the employees would not have liquidity on the exit.
I have two questions from participants here regarding RSUs. So one question, in Israel, there's a practice of having grantees sign voting proxies where they assign their voting rights until an IPO. In the US, from what I'm familiar, this is usually not the way it's done. There are shareholder agreements and the participant sort of joins those agreements. And is that correct?
Yeah, that's correct. It's extremely uncommon, and Justin, let me know if you disagree, for there to be voting proxies for shareholders in the US. And I guess I would also say for restricted stock units, even though it is a full value award, it's really just a right to receive shares. So you're not actually a shareholder until those shares are delivered to you. So you don't have any rights to vote, whereas which would be different if you were a restricted stockholder, where you were actually getting shares. They would have restrictions, but shares would actually be issued to you.
Okay, and another question that's popping up. Is it okay to have an arrangement with an employee where if their option or RSU expires, then the company will sort of reload that grant and reissue a new RSU or option?
I would say it's uncommon. For a liquidity contingent RSU, the issue that we face is we were talking about that needs to be the substantial risk of forfeiture concept. So there really needs to be a real possibility that the award will go away. And if you have a reload feature where you automatically getting another RSU if the liquidity event doesn't happen, I think it puts pressure on that analysis. And so you may not have an RSU which is actually going to be exempt from the requirements of 409A. So I don't typically see that. In the case of an option, you're not dealing with the same considerations. That being said, I also don't typically see an automatic kind of reload feature, because the way that it works is that for the most part, employees will get an initial grant when they're hired, and then they'll get an annual refresh grant. So they should be getting a couple of grants along the way to kind of keep them at a compensation level that the company believes. And that is, you know, someone at the company is actually making an affirmative decision to figure out what they should be getting each year. I don't really see it as an automated process. Do you, Justin?
No. And I think in most cases, private companies, a 10-year option is a pretty long life cycle. I don't see it too often where people have options expiring because the companies either get sold or fail within 10 years by and large.
Yeah.
You have another question regarding relocation, which I know is a complicated issue, but the question is, if I have an Israeli employee who is a US citizen, and therefore I granted him an ISO, and wait, that doesn't make, oh yeah, but and then he relocates from Israel to the US, does he need to exercise, should he exercise early, if that's possible, before relocating to the US?
I mean, I don't think so. I don't know what the benefit of early exercising in that situation would be. Are you aware,
Yeah.
Justin? No.
And with ISOs, does the company have a tax withholding requirement?
Well, if you don't satisfy the tax requirement, the holding period, and then there's going to be ordinary income that's imposed on the ISO, yes. But if there's no ordinary income, then there'd be no tax withholding.
Because there's no tax withholding at exercise, because there's no tax.
Right,
at exercise.
Exactly, yeah. And I guess that's an important point to note. One of the advantages sometimes of granting an NSO is that companies can get tax deductions when there's an ordinary income tax event for the employee, but that's not the case if you're granting ISOs. In my experience, that's not the primary driver for granting NSOs over ISOs, but it is something to take into account to the extent that tax deduction is important for the company.
Okay.
And I guess, Shir, we obviously have still quite a bit to cover, but I am mindful of time. Do you want us to keep going for a little bit, or are there still questions we should answer?
Yeah, I'm actually browsing at the questions. I think the issue of relocation is interesting because we have this going on with several companies with Israeli residents that were granted discounted options because there was no need to grant at fair market value because they were Israeli tax residents. But now they're relocating to the US and they actually have a discounted option. So how are they treated? Because they become US residents. That's what I'm saying. They become US residents when they relocate and they have a discounted option, which is still vesting.
Yeah. That's a great question. I don't think I've actually ever encountered that situation. Have you?
I have not either, but I would. I don't want to speculate, but I would assume that, the IRS would look at your tax characteristics at the time of grant.
Yeah. That's typically how it's done. I agree. That's also my intuition, but it's not something that we encounter. I mean, we can certainly look into it and get back to this group, but I agree that would be my intuition.
Okay. Okay. I think we'll stop. Do you have more? Do you want to continue on 83B?
Yeah, it's up to you. If you have a couple more minutes, we're happy to quickly, finish 83B and restricted stock. But want to be mindful of everyone's important, precious time.
I have another question. Because we're seeing some layoffs in Israel these days. So some companies are trying to better the terms of terminated employees.
Yep.
With accelerating the unvested options or with extending the exercise period because the exercise price is high. Is that permitted and what are the implications?
Can you take it?
Yeah,
Justin?
sure. So accelerating vesting is never going to affect the tax status of an ISO or an NSO. The IRS lets you accelerate vesting. Extending the exercise period, the post-termination exercise period of an ISO, that is considered a modification of the ISO, and so it would disqualify the option as an ISO. So this comes up in the US pretty frequently because employees say, all right, I'm leaving, I need more time, I get it. The one thing you want to be mindful of is if you extend the exercise period of an ISO is to have the employee somewhere in their separation agreement, whatever it is, acknowledge that, they're agreeing to that and they're aware that it's going to disqualify their option, make it an NSO.
And the other point I would note is because these are additional benefits you're giving terminated employees, we typically see companies in the US condition that on releasing claims against the employer. So, as part of the separation agreement, you'll build in all of these benefits and you'll say, as a condition for us accelerating vesting or extending the exercise period, you agree that you will not bring any claims against the company in connection with your termination.
Okay. So maybe we'll say just a few words on 83B election, and I think we'll wrap it up.
Yeah, absolutely. So I can go through this pretty quickly. 83B elections are only applicable to property, which is really restricted stock awards. So we were talking about restricted stock units. That's a right to receive shares in the future once certain conditions are satisfied. But this differs from a restricted stock award, which is where an individual is actually granted the shares. It's just those shares are subject to transfer restrictions, or there may be a vesting schedule that's applicable to them. Restricted stock awards can be granted to employees, directors, consultants. They are not subject to 409A. So some of these very complicated tax issues that we're talking about do go away with restricted stock awards. However, they are subject to another provision of the tax code, that's section 83. Restricted stock awards, because of the tax consequences, are typically granted, at least in the US, in very early stage companies to founders. So when the stock is basically worth a penny or a cent, it's not worth much, founders will get significant restricted stock award grants at that time, and they will make an 83B election, which is an election under the tax code at the time of grant. And what an 83B election does, it basically accelerates the time for paying income tax. So rather than paying income tax when the restricted stock award vests, which is how a restricted stock award would typically work in the absence of an 83B election, you say, I'm going to pay ordinary income tax now at the time of grant. And that's really helpful, because if the restricted stock is worth a cent and you're getting 1 million shares, it's really not a significant tax burden. And then when the shares vest, you do not pay ordinary income tax. You would only pay capital gains at the time that you actually dispose of that restricted stock. So that's really helpful. The important thing to bear in mind about an 83B election, and this is of critical importance, is that you have to make the election, you have to send it to the IRS within 30 days of the date of grant. That is an absolute deadline. It cannot be extended. It cannot be missed in any circumstance. If you miss it, you cannot cancel the restricted stock and then grant new restricted stock to extend the 30-day period. That will not be respected by the IRS. And this is very important because unfortunately, this deadline is missed very frequently. And then we're dealt with the situation of what are we going to do in those circumstances. So if you are a founder and you are getting restricted stock, just remember you have to make the 83B election. If you don't make the 83B election, as I said, you will pay tax at the time that the restricted stock vests. And so if 5 years from now, your restricted stock is vesting and the company's valuation is increased significantly, you'll be paying ordinary income on that fair market value, which can be really expensive. And so for that reason, we don't see restricted stock granted in later stage companies. It's really only reserved for founders and kind of early stage companies. I think we've covered all of this. I know I flew past it very quickly. The last couple of slides, I don't think we have time, but just to put a seed in everyone's mind is that we've been spending a lot of time talking about the tax consequences, but there are also securities laws consequences of granting equity awards to service providers in the US. You have to comply with certain requirements. And I think, again, Shir, I mean, I defer to you, but in our experience, a lot of the non-US companies are not necessarily familiar with these requirements.
Correct. So ask us and we'll tell you all about it.
Exactly.
Okay, so thanks so much, Jessica and Justin. This was very interesting to me. And to the participants, I hope that you at least took one takeaway from this webinar. And of course, if you have questions or you want to reach out to us offline, then feel free to reach out to either Justin, Jessica, or myself. And have a great afternoon.
Great. Thank you, everyone.
Thanks very much.
Thanks, Shir.
Bye-bye.
Bye.